What happens to earnings and what do the markets price in now? What is it that they should be pricing in for the earnings next quarter? Who better than Gautam Duggad, who's been researching all of this to talk about exactly that? Gautam, hi, morning. Great to have you in the show. I was just going through your recent note and you're calling a 10% PAT growth for the MOFSL universe in Q4. And that's, Gautam, quite a sharp deceleration, right? From the 18% that you penciled in at in Q3. What's the single biggest drag that you sense coming in this quarter?
Hi, Aisha. Good morning. Thanks for having me. Clearly there is a moderation. We've seen 5 consecutive quarters of growth acceleration, from 9 to 10 to 12 to 15 to 18. And now that 18 is decelerating to 10. And, it's quite obvious why it is happening. There's been a fairly sharp earnings cut for FY26 as well, for just 1.5 months of disruption that we have seen. We've got earnings for full year for FY26, Motilal Oswal coverage earnings by 1.5%. So that's pretty substantial cut actually, if you think, because for 26, 11 months had already passed. Just for 1 month, we've cut by about 1.5%. And within that, for small cap and mid cap, we've cut by about 2 and 3%. So across the board, there's been some earnings cut. I mean, auto has seen big earnings cut. Cement has seen pretty sharp earnings cut. So has consumer durables, EMS. The only sector which escaped the earnings cut was metals. And for FY26, even oil and gas. But oil and gas has seen a much bigger cut for FY27. So for 27, we have cut off coverage universe earnings by 3%. Within that, for mid cap and small cap by 6% each. But be that as it may, these numbers will keep changing as situation evolves. So one thing that remains certain is uncertainty. Till the time the whole geopolitical backdrop becomes clear, you will see variety of changes in earnings estimates as we move forward in this quarter's earnings season. So while there is a 10% growth for our coverage and 6% for Nifty, next year's growth assumptions are still at about 14% for our coverage universe and close to 15% for Nifty. So that will change in my view in the next 2 to 3 months.
The PAT growth that you're penciling in, Gautam, for the large caps and the SMIDs on the other hand, there's a large divergence there. Why that? And does it make then the large caps safer, mid caps more attractive? I'm wondering what's the thinking?
That's a very good question, Aisha. This has been happening for the last 3 years now. I mean, what is happening is in Nifty, if you take Nifty as a representative of large cap benchmark, in Nifty, 60% of the profit pool comes from BFSI, consumer, and IT. Now, these 3 cohorts of Nifty have been growing in mid to high single digits for last 2 years, right? Whereas the contribution of these 3 sectors in broader market is much lower, right? So that is why there is a divergence between Nifty and the rest of the indices. As I said, even this quarter, for the 10% growth that we have, we're expecting large cap to grow at 8%, mid cap at 25%, and small cap at about 18%. So this divergence between mid cap, large cap has been going on for a while, and I think it will continue because if you decompose the Nifty and look at it sector by sector, in all the big sectors, the big companies are struggling to grow. You look at IT for that matter, the big ones are growing at hardly 7-8%. Reliance profits have been flat for the last 3 years. Pharma, again, pharma, you can go back 10 years also. If you go back 10 years, the 5 largest pharma companies of those days were Sun, Lupin, Cipla, Reddy, and Oro. Put together, the 5 companies put together, their profits have compounded for a decade at 7% and market cap at about 8%. Then you go to consumer, Lever, ITC, hardly any growth for the last 3 years. In BFSI, barring ICICI Bank and SBI, rest of the banks have been hardly growing for the last 2-3 years. So clearly the way Nifty is composition, that is going to create a headwind for anyone who's expecting more than 12-14% growth in Nifty. Whereas for our coverage this year also and last year also, we have seen close to 20% plus growth. And that's where the job of an asset allocator becomes a bit difficult. Because if you remain hostage to the old benchmark-led portfolio management, then obviously it's going to create a lot more challenges for you.
Does underweight private banks largely imply the positioning on HDFC Bank? And with the numbers coming in this weekend, what's top on your radar and what would make you change your view?
So, Aisha, we've been underweight on private banks for more than 2 years now and heavily overweight on PSU banks. And we've been increasing the overweight for last 2 quarters again. In January also, we had removed HDFC Bank by 100 basis point, added that to SBI. We did a similar thing in April preview also. In fact, Aisha, for the first time in our history of model portfolio construction, we have similar weights for HDFC Bank and SBI in our model portfolio at 6% each. And we still remain convinced with the PSU bank story. I think the valuations are very attractive. Plus, their growth is more or less convergent. In fact, last quarter, SBI outperformed every other bank on loan growth. Asset quality is same as HDFC Bank and Axis Bank. If you go by third quarter FY26 gross and net NPA numbers of SBI, and almost equivalent to ICICI Bank. So we think SBI deserves to re-rate a little bit more. Plus, there is value unlocking which is going to happen this year through its mutual fund subsidiary listing. So we are quite bullish on SBI. It's part of our top 5, nifty names for India.
How are you penciling in the headwinds coming on the back of the West Asia crisis, the second order impact on the companies? While you have been you muted the earnings for Q4 for many, going into FY27, how do you look at the earnings growth there?
So, hi, that's what I said to Aisha also, that these things are going to fluctuate a lot before they stabilize. Because right now, please understand, the situation on the ground is very different than what we are trying to factor in Excel sheets. Only people who are thinking about FY28, FY27 are financial analysts, whereas the corporates are right now worried about April, May, and June as to how to get the migrant workers, how to solve the supply of gas and oil, and how to keep the units running. So corporates are taking week by week, month by month. So we'll also have to do the same thing. As we move forward, as companies come and speak in the next 30, 40 days, as earnings season picks pace, we'll also become more wiser. And that is what I said to Aisha, that will reflect in the way numbers get changed. Right now, what we've done is for broader markets, we've cut by 3% for FY27, within which mid and small caps have seen a 6% cut. But Nifty obviously has seen a much lesser cut because the way profit pool is there in Nifty, only 30% of the profit pool gets impacted by higher commodity prices. But as you rightly said, there are going to be second and third order impacts, which are not yet evident. The only difference between Russia-Ukraine commodity spike and now is that in 2022 March, when Russia-Ukraine crisis started, crude spiked to 140. But there was no stoppage of supply. There was no stoppage of business. You took a hit on your P&L and you moved on. This time around, there is a hit on P&L because of higher commodity costs. And also, there are disruptions, as you rightly said, because of supply issues, which will obviously entail a second and third order impact.
You know, the one thing, Gautam, that's really stood out is that Tata Steel is in your top Nifty 50 ideas, but metals you're underweight. What makes Tata Steel the standalone exception here?
Actually, just to correct you, we were underweight. We've made it equal weight now. We've added Jindal Stainless, right? So Tata Steel, we still feel is a clear-cut beneficiary of higher commodity prices, has the highest sensitivity of commodity prices going up. And obviously, stock looks quite reasonably priced, as most commodities are. We played Hindalco last year. Hindalco has doubled. So that's when we shifted to Tata Steel 6 months back. And we are continuing with that position. On top of that, we just added Jindal Stainless. So metals is one sector where we have changed our positioning from being underweight to equal weight.
And hi, Gautam, Harsh joining in. Trying to get a sense, we talk a little bit less about certain sectors, healthcare, cap goods, for example. Now, I know you're neutral healthcare, but you're overweight cap goods in a quarter where you're going to likely see an earnings downtick. And it's the first time in maybe 3 to 4 years that we're seeing a downtick in terms of earnings, right? Give us a sense why you're still overweight. What keeps you there?
So very rightly identified, Harsh. This is the first quarter where we are seeing an earnings decline for our capital goods universe of 6% decline. And this will be the first decline after September 2020 quarter. If you look at the average growth of capital goods universe for Motilal Oswal coverage, in the last 21 quarters, the average growth has been 33%. So if you look at our portfolio, there is a disproportionate tilt towards defense names. We had Bharat Electronics. Now we've added Hindustan Aeronautics. Price was quite attractive in our view at 3,500. Price had corrected, given that there is some delay in deliveries. So we took advantage of that price correction and added HAL at 3,500. Otherwise, pure core capital good names, we only have L&T. And then we have EMS names, which we classify as industrials only. So which is why you're seeing a slightly higher overweight on capital goods. But there is a layered and nuanced positioning there, where there is a big overweight on defense, both BEL and HAL, and just one pure capital good names, which is L&T.
You continue to be underweight IT, Gautam, at a time when the street is sort of, trying to jump ship and saying that, a large part of selling could be now behind us. What convinces you about staying put underweight on IT? Do you not think it's a good defensive play?
So, Aisha, we jumped ship a bit too early. Okay. We have been underweight for 2 years. In November, we made it overweight. And then stocks did well for 2 months. And then, of course, it all unraveled in Feb. The way we are looking at it right now is, I think, the way enterprise adoption of AI will happen will take its own sweet time. But market will not, re-rate them in a hurry. So while there may be a limited downside, but when we construct the portfolio, we are trying to look at alpha opportunities. And that's why we've promptly gone back to underweight after having an egg on our face for the last 3 months. So we've reduced weight on IT. We've cut down Hexaware, Tech Mahindra. We have reallocated that weight to Infosys, Zomato, and we've freshly added Lenskart. So if you look at our model portfolio, the traditional IT plus new age platform now has a 13% weight, within which 7% is traditional IT and 6% is new age platform, which is Zomato and Lenskart.
But no allocation to FMCG staples in your model portfolio, Gautam. Explain that to us. That's a big call.
Yeah, so we've taken that call a year back. We've been underweight on FMCG for 5 years. And last year, we made it zero in July 2025. And we are continuing with that. The reason is very simple. There's hardly any growth that you are seeing in the large cap names there, be it a Lever or ITC. I mean, they're all public numbers now. For 16 quarters, Lever's profit has been flat at 2,500 crores. ITC's profit has also been very flattish at about 4,900 to 5,100 crores. And in consumption, we think today the choices have exploded. So if you want to take exposure to consumption, there are a lot better choices which are available in discretionary. So we've been big fans of Titan for the last 15, 17 years. That continues to remain our number one discretionary pick. We have Indian Hotels, we have Indigo, which we think is a great franchise going through some bit of crisis because of commodity and currency. We have Radico. And if you will, even Lenskart, I would put in the discretionary basket. So we are very clear there. Our choices are very sharp that we will avoid FMCG, even though there may be little downside left there, but they can see more time correction or underperform the market. I mean, if I had to choose one FMCG name, I'll choose some of the food names which are available, either a Britannia or a Tata Consumer. But broadly, we'll stay very light on traditional FMCG names or traditional consumer names and have our allocation more towards discretionary basket.
Continuation of that, Gautam, you specifically do like new age platforms, right? Eternal, Grow, the high beta nature of them, the fact that they're the ones to fall first in a risk-off market doesn't deter you, right?
Look, Aisha, I mean, see, it's always very easy to get carried away when the stocks in your model portfolio are doing well, and Grow is one of those names. We added at 150 rupees in November. In fact, it was 150 rupees till 30th of March. And in the last, I think 15, 16 days, the stock is up close to 35%. Now commands a market cap closer to BSE. As the only broker which is trading at a 40p. But the growth is stupendous, Aisha. I mean, our projection is in next 2 years, the earnings will double from 2,000 odd crores to 4,100 crores. So we are, so largely our thought process when we construct the model portfolio and choose the ideas is growth visibility and of course, some bit of reasonable valuation. So you will rarely find very heavy duty value names in our model portfolio. It will always be tilted towards growth, and that's where names like Grow fit in.
And within the capital markets play, aside of Grow, are you also looking at asset managers as well?
Yes, absolutely. So we've been very bullish on capital market theme for last 3 years. If you look at our model portfolio, we've had variety of AMCs. We've now added ICICI Prudential, which has recently got listed, and we've initiated coverage there. But look, in our model portfolio, typically we'll have 34, 35 stocks. But if you have to really play the capital market theme in India, and we remain extremely bullish there from a next 5 to 10 year perspective, I think the right way to construct a portfolio for capital market is to create a basket of one broker, one exchange, one wealth manager, one asset management company, and maybe a couple of intermediaries. And that's how you benefit from the whole ecosystem rather than putting your egg in one basket. Because if the demat account addition continues, the financialization of savings continue, and the nation transforms from being a saver to an investor, there are a whole host of companies which will benefit. Already they've seen great wealth creation over the last 2-3 years, but I think we're just about beginning. And that's why I mentioned to Aisha that we are looking at construction of portfolio today. If you remain hostage to benchmark, and therefore remain tilted towards traditional banks and traditional consumer and traditional tech, the chances of underperformance goes up significantly. So in consumption, you have to look at discretionary. In financials, you have to look at capital markets. In tech, you have to look at new age platforms. Similarly, in industrials, you have to go beyond the typical core capital good names, look at industrials, EMS, defense, those kind of things. That's where a portfolio construction approach has to change in conformity with the changing times.
Back to the capital markets thing, you spoke about that you need to have a diversified portfolio within capital markets. What's your view on the broking entities? Grow, we heard what you have in mind, but other broking entities, discount brokers, do you see pressure coming in because of regulatory changes and others in broking entities, and you should be cautious on broking?
We've seen variety and multitude of pressures coming in from regulator. There are a whole host. I mean, if you sit down and jot the announcements which have happened over the last 2 years on F&O, on brokerages, variety of things pertaining to AMCs and capital markets, I mean, a lot of actions has already taken place, and the industry has seen through it all. Do remember, I represent a brokerage which is a listed company, so ample disclosures in place. But what I am telling you is, look at this space beyond next 3-6 months. The regulations will keep changing. A regulator will keep reacting to the evolving developments. Wherever they want to curtail the extra enthusiasm or exuberance, they're right in doing that, so that the industry keeps growing on a compounding basis over a period of time rather than getting heated up too fast too soon. And therefore, that's welcome. What I'm mentioning, and just to repeat that point, we've been bullish on this theme for a decade, out of which last 3 years has played out perfectly well. And we remain equally bullish for the remaining 5-6 years. And we will have to keep looking at this regulations on time-to-time basis, because do remember, this is a cyclical pace and a market sentiment plays a big role. So this is not going to be steady one-way compounding, linear compounding. There will definitely be cases where stocks correct 20-30%, then they again rally. So you have to be able to handle that volatility.
Okay, Gautam, thank you so much for joining us this morning, giving us that perspective. That's all. Unfortunately, the time that we have, we've run out of it. Thanks so much for coming in and speaking with us. And viewers, that's, again, all the time we have on this edition of First Trades. From Aisha, Sajid, myself, and everyone who puts this show together, thanks so much for watching. Stay with us here on ET Now, Midcap Masala, to take all the action forward.